Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today I'm joined by a very special guest, Bennett McDowell from traderscoach.com, to provide us a slightly different view today on trading options. And I like doing these webinars with guests because what I think it provides us with is an external view as to how other users may look at the markets, how other users or participants might utilize options, as well as options play. Bennett is actually someone who's been using options play for quite some time. So I'm actually really excited to have him on today to go over some of his thoughts around the market, look at some ideas that he currently has, that he sees opportunities that he sees in the market, and see how we can play it using options. So first of all, I want to say a big welcome to Bennett. Bennett, can you hear me?
I can, Tony. Thank you. Great to be here.
Thank you so much for joining us. So today we're going to go over a few different things, but today predominantly what we're going to do is we're going to go over some of the slides that Bennett has prepared with some of the opportunity that he currently sees in the market. But we are going to take a little bit of time and just go over the current market outlook, what we currently see. We did say that this webinar is going to be more about hedging your portfolio and preparing your portfolio for a recession. But I think with the market at all-time highs, we're not necessarily concerned about a recession, but we are concerned about short-term corrections. So I do want to address that, but we're not going to focus our attention today on recessions, but more about some of the trading opportunities that Bennett has actually brought to us today. So with that, what I want to do is I want to first introduce Bennett. Bennett, why don't you take a couple of minutes and just give everyone a little background as far as, your trading background, your history with trading, and, why what you do for a living.
Yeah, sure, Tony. Thanks. First of all, again, great to be here in front of your group. First time on the Option Play webinar circuit, so to speak. So it's great to be here. I started trading back in the late 1980s, early 90s. And actually before then, I was actually in real estate. And one of the things that was interesting about real estate is that when the markets are going up in the real estate market, hey, you're doing great. But during a recession or downturn, real estate's really tough to make money in. And that kind of brought a change in my total career, so to speak. And I got involved in the markets. And I really have never looked back since, because the markets, what I love about the markets is it gives us an opportunity whether the markets are going up or down. So whether we're in a good market, sideways market, or even a bearish market, there's always ways and opportunities to make money in the markets. So that was a big draw for me. And when I first started getting involved in trading, I was actually doing mostly options. And Tony, I wish I had options play back then, because I sure could have used it. There was not a lot of software back then. It was mostly DOS based and pretty clunky and pretty buggy, but nonetheless, usable somewhat, but not like it is today. And so it was really, it's really been quite a journey. I eventually went into some of the bigger brokerages like Morgan Stanley, Prudential Securities, started managing money for high net worth individuals there, created a very high velocity short-term trading fund there for high net worth investors. We did really well. And then folks wanted to know how basically I was doing my trades. And that's where we started traderscoach.com, not primarily as a website to sell products, but primarily just as a meeting place for these people in which I was managing money. And then we developed the software, and here we are today. So it's funny how things move along, but it's been a great journey. I think trading in the financial markets is the best career ever. And I think options gives it a real boost. And so I'm excited to talk about that today.
Well, I'm excited for the different, my background is actually in technical analysis, and I know that you do a lot of technical analysis in your trading. So I'm really excited to have you come in and bring a different view as to, how you look at the charts, how you look at the market. Right. But, at the end of the day, we actually converge back using options to express our views in the market. And that's what I think is great about having guests on the show is being able to show users that regardless of how you go about finding your ideas and your analysis, that we all converge back into utilizing options in our trading. So those are some of the examples we're going to go over here today. So Bennett,
Yeah,
why don't you go ahead and take over the sharing of the
okay.
screen? Let me stop sharing. Let's see. Okay, you should be able to take control now of the screen sharing.
Okay, how's that?
Perfect. Great.
Okay, good. So we're good to go? All right, excellent. All right, good. So we've done the introduction, so we're done with that. But, you know, also too, if you want to learn more about our approach to the markets, one of the big things, Tony, I focus on is risk control, whether you're using options or just purchasing the underlying asset. I think risk control is really, really important. And so I think that's an area that everybody needs to be using. So if that interests you, you definitely would be interested in some of these books out there, because I really focus on risk control. I also focus on other forms of technical analysis as well. Now, for fun today, we've got a article here that I wrote back in a while back in Stocks and Commodities on risk control and money management. And there's some formulas in there that I really think would help people. So if you'd like that, we'll put a link up in the chat area for everybody, and they can click on that link. And basically, it's a free download, okay? So that's something we like to make sure everybody has, because I think money management plays a really, really important role in being successful in this business.
And
so Tony, I'm sorry.
I don't want to interrupt, but this is something that I've said many, many times, right, about managing money. This was actually the topic of webinar that we did in the first webinar in December, which was risk and money management of your portfolio is absolutely paramount to any type of trading, whether you're trading options, stocks, futures, Forex. The ability to control risk in your portfolio is the most important thing, because if you don't control risk and you blow up your account, then you no longer have any capital to continue trading. And it's so important. So I really recommend that you guys take a look at perhaps a different view as to how to look at risk of your portfolio. So sorry, Bennett, go ahead.
Oh, no, that's great. No, you're absolutely right. You know, I've always thought too, Tony, that the difference really, when you come right down to it, between a professional trader and a novice trader, that door that separates them is risk control. And you can take somebody with a system that's really pretty lame in terms of a high percentage return. But if you have great money management, you can be profitable even with a system like that. So money management is a really, really powerful aspect that you really have to master, I think, to do well in this business. So yeah, so I am 100% on board with that. All right, so let's talk a little bit about the overall market. You know, I'll tell you, the market has been amazing. It keeps going up, 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 up. Yeah, we've had a few pullbacks. We're probably due for one pretty soon, I would say. And what Tony and I are going to do a little later in the presentation is kind of take a look and see how you can protect your portfolio through hedging during the next pullback on the Dow. But for right now, we're looking at a continuation of a move to the upside. Now, with that said, you know, we always know that trees, you know, do not continually grow to the sky. Eventually, they have to stop and take a breather. And the same will happen with the markets. But we're looking at a target range here, I would say, between around 28,610 and 32,875 on the current intermediate trend in the markets. Now, there's going to be some short-term movements to the downside before we reach there, but as you can see now, we're getting really, really close. And what I like to do is I like to take a look at different time frames on different markets. For example, this is the Dow, but you know, you could look at the S&P and so forth, and they're all very similar in configuration right now. And the path of least resistance currently is still to the upside. Now, with that said, all right, we've been in this move to the upside for a long time. So I'm not a good believer, a real believer in getting in late on trends. And so I think actually long trades are becoming more and more risky as we reach these higher plateaus in the market. And I think eventually we're going to have some really great opportunities for some short trades, and maybe next year at some point. Now, the question is when? Well, the markets can be very funny. 2 + 2 does not always equal 4 in the markets. And we have mania tops where things get irrational and keep going up. I remember back in the year 2000 when we had the dot-com bubble, I don't know if anybody, I'm sure many of you were around then, some are not. But during that time, I was at Morgan Stanley, and all the analysts were saying, none of these companies are making money. The dot-coms are there, and people would be buying these things and they'd be going up. And that was a perfect example of where logic, okay, was overridden by emotions in the market. Everybody wanted to be part of that dot-com movement. And so that happens with the markets. And so as a really good hedge fund manager, Tudor Jones basically said, is that you want to follow price. And the least resistance with price right now is it's trending up. So you want to trend with it. And when it changes, you change along with it. And so I think that's a really important aspect in taking a look at the overall markets, that the price is still moving up. Now, with that said, all right, doesn't mean we're going to get pullbacks, especially on some of the shorter time frames. And so we're going to take a look at a hedging position that I think you could probably take pretty soon on the Dow, and we'll go over that a little bit later in the presentation. But for now, we're seeing that the markets move up, and I would think that's going to continue for the short term over the next, let's say, month or so. And then we'll take a look and see what's cooking next year. But we'll wait for price to tell us, because price will break through some of those trend lines. They'll break through some of the support levels. Now, the software you see in front of you here is proprietary software that I have at traderscoach.com. But the main point is that we use technical analysis in doing our actual forecasting of the market. And when we talk about forecasting, don't forget, forecasting really is a form of probability analysis. Nothing is certain, nothing's 100%. And I think it's really important to remember that when we talk about even things like target zones and so forth. So I kind of like the price to verify the forecast, so to speak. And the price certainly is moving up towards the forecasted target zone. So far that seems to be something that is playing out at this particular time.
So you give forecasts up to around just slightly above the 30,000 level on Dow?
Yeah. Actually, we're looking at a couple different target zones. You can see one here, Tony, that I have wave 5 target zone based on the 60-minute. So we'll probably get up to this area here where my pointer is, and then move back down. And that's going to be an opportunity, I think, for people to hedge at that point. We're going to take a look at a chart a little later on in the analysis on a 60-minute chart, where we can take a look at that and see what kind of hedging we can do on that, maybe using something like the Dow Diamonds or something like that. But in any case, then after that, we expect a rebound and moving back up probably into that higher probability target zone above there. But things don't move up in a straight line. So I think probably the short-term target zone is that area where it is marked in blue, and then a pullback and then a resurge forward.
And just for everyone here that's on this webinar that may not be as familiar with technical analysis, specifically Elliott wave, which is a form of technical analysis, just so I'm clear, that
Sure.
big 4 that you have in the middle of your chart, is that the mark of a completion of a wave 4, and now we are in a wave 5?
That's correct. Right.
So for
Right.
those of you that are new to technical analysis, Elliott wave is a way of structuring where we believe the markets are going to go based on waves, if you will. And I believe there are 5 waves up and 3 waves down, right? So we're currently in the final wave higher. If Bennett, if you correct me.
Tony, you are a pro. You are absolutely right. And it's funny, when I talk to groups, I have to remember sometimes that not everybody is on board with different forms of technical analysis. So thank you for bringing that up. But yes, there's actually 5 waves in an Elliott wave trend, and waves 1, 3, and 5 are all considered impulsive waves, and they move in the direction of the actual trend. And then they are interrupted by waves 2 and 4. And there's a whole bunch of math regarding the retracement values and so forth, and then the extensions of where these waves go. And this wave 5 high probability zone and wave 5 target zone are part of Fibonacci extensions that we use based off anchoring the extension from wave 2 to wave 3 to wave 4. And so that's how we arrive at these target zones. And so that's a good thing to explain, because that is how, important, because that is how we attain these target zones. And don't forget, it's probability. Everything is probability. For example, there's a 70% probability that wave 5s end in this box right here. And that's pretty high. So we go with the probabilities.
Okay, I just want to make sure everyone understood that before we moved on.
Yeah, good. Good. Yeah, if there's anything like that that comes up, please, feel free to pop in and help out. All right, cool. All right, so basically to summarize our feelings on the Dow, all right, we are getting closer and closer to a significant target. Now, there's one other time frame that I really didn't mention, and that's the weekly time frame and the monthly time frames. Those are both extremely bullish right now. And any correction that we have, even on the daily chart, even though it may last a few months, it's not a change in trend on the long-term charts. So the long-term charts are really pretty much saying that we're heading back up after a significant correction in 2020. All right, so let's move on here. Let's keep going here. All right, the next thing here to talk a little bit about is options. Now, everybody here, obviously, for the most part, knows most of the basics on options. If you don't, feel free to ask, of course. But with options, the nice thing about them is leverage. All right, everybody knows that's one of the big things about using options. And I would also go as far as to say it's actually a great way to control risk. Now, many people think of options and like, oh my gosh, especially the new folks, they're risky. They're risky. Actually, they're not. If you know how to use them, they're not risky. All right, there's certain option plays that can be risky, no question about it. But once you understand what those are, then you don't do them, okay? So there's ways, real sufficient and excellent ways to control your risk with options. There's also multiple strategies that we can use for bullish, bearish, or sideways markets. If you buy an underlying asset and it moves sideways, you don't make any money. But with options, we can actually take some income in during those sideways markets and actually work off the time decay to make money in those. So big benefit in using options for things like that. We can also take advantage of an option's intrinsic and time decay. We do that in a variety of different ways. If you buy calls, sometimes it's much better to go into the money with them and get a more intrinsic value on those, because then you get a more closer movement in the premium price as to the underlying asset. Of course, you have to take into consideration gamma and the Greeks. We'll go over that in a little bit as well. All right, one of the best things though about options these days, and I got to tell you, Tony, is options play. All right, again, I wish I had this software 30 years ago because it is so intuitive and easy to use. And they're not paying me to say this, folks, all right? But I've used a lot of option software, and what options play does is it makes the math part of it really easy. So we're going to show you how to use that as well. All right, and our goal, of course, as traders, as option traders, is to make money in all different types of markets. Because if the market's moving sideways, you can make money in that market. All right, because a lot of times markets do move sideways. They don't always take off like we're seeing now in the markets. All right, so first thing we want to do is basically realize that every market we look at gives us numerous ways to take advantage of the price movement. Options increase this advantage. Knowing the direction of the underlying asset allows us to zero in on the best option play strategies. Now, I want to stop there for just a moment. Last week, Tom Snosnoff was on and did an excellent presentation. Now, Tom is a real quant kind of guy, all right? He really doesn't focus on chart direction like I do. And so it's a little bit different twist. Like Tony said, it's great to have different speakers on because you have a little bit different twist. A lot of novice intermediate traders focus on chart direction. And that's where I think you're going to enjoy today's presentation. And then as you get more advanced, you can take advantage of the more experienced type of option plays, including all the vertical spreads and things like that. So one of the interesting things, though, is if you know the direction of the underlying asset, which is step one, you can then pick the option strategy to take advantage of that movement and the underlying asset. So that's what we're going to focus on. And the option play software makes it easy to do that. Once you have the direction of the underlying asset, then we go to the option play software, and that does the math for us. So we're going to take a look at that. So I want you to look at basically simplifying options for a moment. I don't want you to overcomplicate it. I want you to think of it as two simple steps. First, choose the market. Now, how are you going to choose the market? There's a variety of ways, and we could spend literally an hour going over that. But you know, you probably have a way, maybe scanning, maybe news events bring you to certain markets, technical analysis. Hey, some people use fundamental analysis, okay? Whatever market you want to hone in on, all right, you can do that. And if you have some long-term holdings, you can use options for hedging too, all right? Then obviously the next thing, once you have the market in front of you and you know what direction or market cycle it's in, then determine the best option strategy using the option play software. All right, so keep it simple, stupid. That's what we're trying to do here. All right, so let's just take a look at an example here. And Tony, feel free to chime in as well. All right, so here's an example where we actually have a stock at Starbucks, and this is a fairly recent chart here, okay, in December here. And we feel it's going up into this target zone here. So you have basically a few options. You can buy the underlying asset at $85.43 when this chart was done, okay? Or you can use options to leverage your money. Maybe you don't want your money tied up that long in it. So in any case, this becomes very important because we know right now we're looking at a bullish option play. And so we're going to talk about what kind of options work for bullish option plays. Now, if we go to another chart, all right, here's lumber liquidators, different type of configuration. All right, if we go back to Starbucks for a minute, we're looking at an Elliott wave 5, and this is the end of the trend up here. And if we look at this chart, what we're doing here is looking at a bottom of a 3 and a wave 4 fib retracement, but again with a bullish target zone. Now, what's interesting with this stock that you don't see as much in the one previously is we've got kind of a sideways market. So, and we got a pretty cheap stock. A lot of people would buy the stock and just simply write a covered call with the strike price being in the target zone. That's one way of doing it. There's many, many other ways of doing it. So let's just talk about that a little bit. One of the simplest ways to take advantage of a bullish market is to buy a call option. Now, if the market is a bearish market, if we had a bearish target zone, you just reverse this. It would be a put option. But it's the same idea. So let me just see what's out there in terms of, give me a second. Tony, I'm trying to see where my messages are.
There's a chat window at the bottom of your screen.
Okay, hold on a second. I think I got it here. Okay, questions and answers. Is that it?
No, there's questions and answers in this chat. So I would go to the chat.
All right, give me 1 second. I lost it. I had it. Oh, there it is. Okay, hold on. It's a separate window when you're presenting full screen, I guess. All right, so I've got the chat window open. Okay, so let me just ask you, on a call option, what are the pros? What's the pros of using a call option, a simple buy option? And what about the cons? Okay, so there's pros and cons for everything. So anybody?
So just so everyone knows, we're in the chat window here. Just type into the chat window.
All right, so here they're coming in now. Okay, so limited risk, okay? Let's talk a little bit about that. So when we talk about limited risk, when we buy a call option or a put option, but in this example, of course, it's a call option, you can only lose the amount of money you pay for the option. Now, as a rule of thumb, if you have a trading approach where you're winning 60% of the time, and you have a payoff ratio of 2 to 1, so your average wins are twice as great as your average losses, then a 2% risk on each trade can make sense. So if you have, let's say, a $50,000 account, then a 2% risk on that would be you don't want to lose any more than $1,000. So you could simply buy $1,000 worth of calls. And if they expired absolutely worthless, then you'd lose $1,000, which is 2% of your account size, which is an acceptable risk based on your win to loss percentage and your payoff ratio. That's just a simple way to do it. There's other ways you can certainly do it as well, but it is limited risk. So absolutely right on that. What else? All right, it's cheaper than buying the stock, okay, as Perry says, all right, because you get leverage, right? All right, so you don't tie as much capital up as you would in buying a stock. And this is really important when you have an expensive stock, right? All
Yeah,
right, so go ahead.
and I think what Casey said, what Perry said, and a few other people have said is time decay, theta working against you. That's the biggest con, and I think that's one of the biggest challenges to buying.
Absolutely. And that's why, you know, you hear a lot of times that such a large percentage of the buys don't make it. Okay, they end as losers because of that very reason. So what you need to do, one of the things you need to do is you need to do a few things right when you do a buy a call option. One is you have to have a target zone. You need to know where prices are going, and you need to kind of have an idea of how long they may take to get there, because that's going to determine how far out you need to do the option. And you need to remember also that in buying an option or selling an option, time decay is not linear, okay? It actually erodes much quicker in the last 30 days of the option than at any time. And so when you buy those short-term options, you have to realize that time is not on your side. The time decay is not on your side. So that's where the Greeks come in, and we'll take a look at those. All right, so there are pros and cons to this. It's a very simple strategy. And at the top here, you can see I have it great for beginners because it's level 1 options approval. The other thing you have to take into account, depending on how long you've been trading and what your experience level is you have to start out with the broker's approval to do certain option plays. And so an option 1 is the basic approval. They'll pretty much give that, I think, to anybody as long as they have enough money and can breathe. I think that's about right, right, Tony? I think if you can breathe, they'll give you an option 1 if you ask for it. And that allows you to do things like buy calls and puts and do covered calls and things like that. All right. So I think we pretty much handled a lot of this. The delta here under questions is kind of important because, you know, when you have a target range, you have a short period of time and you have time decay working against you, you need to go enough in the money so you get the as close a movement in the options premium price as you would in owning the stock. Because the deeper you go in the money, the more intrinsic value they have, and the less the time decay will affect you. It will affect you to some degree, and there is the gamma to think about as well. So we'll cover that in just a minute. All right, so that's a possibility, okay? And does this produce any income? Do we get any premium income off this? And the answer, of course, is no, because we're actually paying in order to purchase the call option. All right, let's go and take a look at another possibility to take advantage of that target zone. All right, you could buy the underlying asset and write a covered call. So what are some of the pros and cons on this real quick? When you're talking about buying the actual underlying asset and then writing a covered call. All right, this is an income strategy, right? So in a case, and it can also be a profit strategy. So when you're buying buying a covered call rather, you are owning the stock. So it is, they do allow this for level 1 options approval because it's a fairly safe option play because you own the stock. And the idea behind this is that you want to put your strike price once again for the call option in the target zone. And think about it. If you could sell a covered call, get income for that, and then at the same time, if the price moves up and you get called out of the option, all right, you get called out of the stock rather, at the strike price, well, you've done what you wanted to do. You made money on the stock, and you also made a little additional money on the income. All right, so that's a possibility that can be very easy to implement for level 1 option traders. And so that's kind of a cool thing.
What I find interesting is are the responses saying that the cons of selling a covered call is limited upside.
Yes. Well, yeah, you're absolutely right. There's all, you know, it's in the markets, there's no free lunch, right, Tony?
Well, I actually, want to provide a different perspective on this, as opposed to thinking about covered calls as a strategy that limits your gains. what it's actually doing is providing you a way to exit your stocks when they rally significantly. So, this is part of one of the things that we teach at Options Play is that when you're selling a covered call, you should sell a covered call at a target price that you have on that stock. So when the stock reaches that target price, you're able to actually take profit on that. Just like when you place a limit order, guess what? A limit order also caps your upside, meaning if you have a $15 limit order and the stock shoots up to 17, you've also given up that $2 upside, right? So
Right.
the covered call does the exact same thing that a limit order does in terms of limiting your upside above a certain level. But the whole point of selling a covered call and placing a limit order is because you're comfortable getting out at that price. So that's one of the things that you should really consider. And you're getting income while you wait for your stocks to rally, something that a limit order doesn't pay you. So I hope that provides users here that have said, that covered calls limit your gains, a different perspective as on covered calls, because it's really allowing you to take profit at a price that you're comfortable taking profit at.
Absolutely. I couldn't agree with you more. Well said, Tony. The interesting thing is if you look at this chart here, all right, this is not a stock that we want to buy and hold here, because if this is an Elliott wave 3 to the downside, we're playing a bullish retracement, and then the market should sell off again. So we actually want to look to get out in that target zone. And that's exactly what a covered call would do for us. Now, the nice thing is if it takes a little longer to do it, let's say it keeps moving here and the option expires. Well, we get to keep the income, and guess what we can do? We can write another one. All right. And that's how you can gain money from a market that's moving sideways. And yet at the same time, if it goes from 10 to 20 bucks, that's 100% move in the underlying. And if you can get a delta to come close to that, you won't. You'll probably get one more like around 80 or 70 at the most. Then you still made a decent income on that. Yep. All right. So it's a plus.
Most of the time with covered calls, we're seeing anywhere from 5 to 15% yield in addition to the dividend that you're receiving on the stock itself. That is in my opinion, a compelling yield to gain while you wait for your stocks to reach the target prices that you want them to hit. So those are the types of things that I think I would love for our users to think a little differently with respect to covered calls.
Oh yeah, I agree with you. The big con for me that I see in covered calls, okay, is what if the stock instead of goes up, does this, goes down. All right. Now, the income you receive from the covered call may not offset the drop in the stock's price. And that's where people can get themselves in trouble. So you have to have a game plan. If it goes below a certain stop here, like it shouldn't, in this particular strategy, all right, this is a high probability target zone only if this bottom holds. So if the stock sells off and goes below that bottom, you got to cover the position. You got to get out. Okay, unwind it. Because what you could do is I've seen people buy stocks at $10, right? The covered call, the stock goes down to $3 or $4. They're still holding the stock. They still got the call, and now they're looking at a huge loss on the stock. So you don't want to fall into that. That to me is the biggest issue that I think in terms of causing a problem. But if you have a game plan to exit the position, then you're going to be okay. It'll end up as a loss, but that it won't end up as a huge problem. All right, so that's covered call. Now the other option you could take advantage is a synthetic long, okay, using options, and these are our spreads. For example, you can buy a call and sell a call and create a bullish option play that way. So we're going to go over that as well with you because that's what is involved in the option play software. That's what it does. So what I'm going to do here for just a moment, all right, is I'm going to in the slideshow, and I've got a chart up here, and let's just take a quick look here on this one. This is Starbucks, okay, over here, and then I'm going to bring over the option play software, just like that, okay, right next to the chart, so you can kind of see that for a moment, and then we'll go back to the PowerPoint in just a bit. All right, so I've got Starbucks in the option play software. Now, one of the things you want to do when you first get this software is to become familiar with all the different bells and whistles on it. It's very easy to use. It is very intuitive. There's a lot of software that I will try, and I'll know in a day if this is going to be something for me or not. With Options Play, I knew in a second that this was the software that was going to work for me because it's so intuitive. And what do I mean by that? Well, you type the stock in, you indicate whether it's a bullish or bearish forecast, and they have an internal setting on some analysis that they use, but you can override that by indicating whether you're bullish or bearish depending on your own methods of determining target zones and things like that. So if we take a look at Starbucks, all right, this is a trade, okay, for this one. Let's just say we're not doing a covered call. Let's just say we're buying a call for right now. So here's a situation. They have 3 windows up here. They have one, they compare to buying 100 shares of stock, and then they have just simply buying a call, and then they have a vertical spread here. So those are the 3 windows. So let's focus for a moment on just buying a call, which is this center window here. So if we take a look at there, all right, they have a whole bunch of information here, and we'll walk through that. But if we take a look at the Starbucks chart, okay, we're in December, we're sitting at 85. We think this is going to 110. It's certainly not going to do that tomorrow, all right? It's probably not going to do that next month, but probably sometime in the spring, it could be in that area. So why don't we focus on an option that sometime would expire sometime in the spring? So what it allows you to do is come down here. If you click modify, and Tony, feel free to chime in at any time if you see me doing something wrong or you could do it better, okay?
You're doing great.
Okay, so if we choose the April, all right, we plug that in. The next thing that we can change is the strike price. Now, what I like to try to do, and it's going to depend on the Greeks in a moment, and again, we'll talk about that in a minute, but with a price of 85, a nice strike price would probably be around 85. You want to have a little bit of intrinsic value in there. And then you want it called. Now, the premium price is $630 per contract. All right, now check this out. So if this is something you think is pretty good, then you can hit trade, and it tells you exactly what to do here. All right, expiration, repeats the strike, type the premium. Okay. The risk is 630 bucks. So that's the most you can lose per contract. All right, days to expiration and so forth. But also too, you can change the strike price. Okay, we can go deeper in the money by going lower in price. It's going to cost us more, okay, but it will have more intrinsic value. And then what you can do is come down here, all right, and go through the trading range simulator, all right, which gives you, if you enter the trade here to here, you can adjust the settings. You can take a look here at how much you can adjust the risk again, and also too, in plain English, what exactly is going on. This is a bullish strategy with limited risk of $1,005 and unlimited profit potential because we're just buying a call. So it gives you all the information right there. And then here, we can even make some adjustments. So if we think it's going to 110, all right, by then let's just move it up here and just see what kind of how that affects things a little bit. All right, it's not going to affect the trade cost, is it? Because that's going to remain at 105. All right, we've got here and here and volatility. So it gives us a lot of information. If it reaches that price, we got 185% return. Not too shabby. Now, if you click on this box here, all right, it takes you to even more information. And then check this out, explain strategy in the Greeks. Okay, so here you can go here to the Greeks. Now, let's talk about delta. The delta is 78.15, which isn't too bad because you're in the money on this. The gamma is 2.34. So when you're thinking about gamma, all right, basically gamma estimates how much the delta will change when the stock price changes. So both the delta and the gamma are basically going to change. Think of gamma as the acceleration in the delta. That's that type of thing. Also, too, we've already mentioned that the delta kind of what it does is it sets the pace of how much the premium price on the option is going to move in relation to the underlying asset. But another definition of that would be gauge the likelihood that an option you were considering will expire in the money, too. That's another estimate for delta. And then theta, okay, is how much your option might lose each day as it approaches expiration. All right, that's the value if it's losing. Again, Tony, if you got any more information on this or can improve it, feel free to jump in here. Vega understands how sensitive an option might be to a large price swings in the underlying stock. So, you know, these things, the Greeks are important to understand because as the option moves in price, okay, these numbers will change as well, which may cause you to modify your strategy again at some point. But in any case, the information's all here. The math is all done for you. That's the wonderful thing about options play, is that literally you can really not know that much about options in terms of the math and still be an options player. All right, you got to love that, right? All right,
this is where I think I'd like to have a little discussion with you regarding, you know, some of the things that people have said regarding, you know, why the pros of buying calls and how to actually maximize those pros and minimize those cons, right? So
yeah, good.
You looked at an April $80 call option, which is deeper in the money than I would typically trade. But let's keep your $80 strike.
Okay.
Let's keep your $80 strike, and let's modify the stock leg. The left strategy on the left-hand side.
Okay, which one?
The left strategy. So if you click on modify for the left strategy.
Oh, this one. Okay.
Yep. And let's change that to a call option. So if you use the strategy constructor, which is right above.
Well, I haven't done this before, Tony.
Okay.
I always stayed in the call area here.
Okay. So let's do this. So you see where it says the strategy constructor and says long stock?
Oh, yes.
Let's click on bullish. Let's click on long call. And now let's change that to the April. Let's keep the April expiration.
So you want to change this to April, right?
Mm-hmm. April.
Hold on one second. Okay, go.
And let's do the 87.5 maybe.
87.5, okay.
Yeah. So you chose the 80 strikes, which are significantly deeper in the money. It costs $1,000 and $1,005, right?
Correct.
My research shows that I think you're better off buying just a slightly in the money call, an 87.5 call. And part of this is because, like I said, what we want to do is we want to maximize the pros while minimizing the cons, right? So when you do a deep in the money call, you certainly minimize some of the cons, which is theta. Your theta was only $1.50 per day on a $1,000 contract. That's very, very small dollar amounts that you're losing. If you click on the Greeks for my strategy, the left-hand strategy.
Hold
on. You just click on the P&L chart.
Okay. Got it.
The theta on mine is $1.73, which is a much larger chunk of the 475. So from a percentage perspective, I'm losing much more, and my delta is smaller. But my gamma is significantly larger. And the fact that my delta is 55 versus yours was 78, but the fact that mine costs less than half of what yours cost, what happens is that even though my deltas are smaller, when the trade goes in my favor, because it cost me less than half, I'm going to actually have higher leverage than you do, yet I risk less than half of what you did. So that's really why, you know, and if we go back to the P&L simulator, you'll see that if we go back to the P&L simulator.
Okay, where is that one?
Which is the first dot at the very bottom.
Hold on a second. This one.
Yeah.
Okay, got it.
Now, as you can see, when you moved your slider all the way up to 108, notice how the difference in the returns. Yours returns 185% return versus the other one returned 475%. I'm sorry, 345%.
Right, this one.
So even though I have a smaller delta, which means that I make less per dollar when Starbucks goes up, but because mine costs half of what yours costs, it's going to provide me significantly more leverage. And as you can see, almost double the returns that you would expect on that more expensive option. So this is why our research shows that when we're buying options, we want to buy in the money, but not too far in the money. because the further in the money you go, you're mostly just paying for intrinsic value and you lose that leverage ratio. So, a lot of people said leverage is a pro for buying a call option, and that's absolutely right, and especially limited risk. So the goal here is to increase our leverage while decreasing our risk, and that's why our research shows that when you're buying a call option, you want to look at about an at the money. And someone asked, what's the delta on mine? I think the delta on it was about 55, which is right in the sweet spot that our research shows gives you the best bang for your buck, so that you get the maximum leverage, the least amount of risk, and your theta or your time decay is relatively smaller compared to someone buying an out of the money option. Because a lot of people will say, well, then just buy an out of the money option because those are the absolutely cheapest, right? And you'll get the most leverage. But when you buy those out of the money options, what you're doing is most of it is going to time decay, and you're losing a lot of time decay every single day. So that's
excellent. And that's why I wanted you to chime in, because there's a lot of stuff like that in the option play software that once you become familiar with, you can change the different variables and see what the different results are. So that's really excellent. So the other thing too, which is interesting, I didn't even know you could do this, Tony, was that you could actually click on this and actually change it or modify it and make it also a call to compare the calls. That's kind of cool.
Yep, we really built this so that you can compare any three strategies side by side.
Yeah, I never realized that. That's because I never used that modifying button down there. So that's really good. Now, the way I was also doing it on the covered call situation, or not the covered call, the buying the call, was I was going through each strike price and looking for the good number. So I just started at 85, but certainly you could go down or up and see which Greeks make the best sense, and also which play would make the best sense as well. So, and as Michael says here, he goes, when you go deep, have a high delta, okay, it's a better protection if the trade goes against us. So he's
I would argue that that's not the case, because the deeper you go, the less protection you get, because you're actually losing more per dollar.
That's what I was going to say, right? So that's not exactly correct, and that's why you want to rely on the option play software to do that. Okay, good, excellent. All right, so what about also, Tony, let's talk a little bit about verticals, okay, on something like this. Is it right to say when we talk about verticals, it's really creating a synthetic buy?
A synthetic buy. So I'm not exactly sure what you mean by a synthetic buy. The way I look at verticals is really just taking exactly what everyone just said, which is you want leverage, you want
and try to minimize, right?
Yeah, you're trying to maximize your leverage while minimizing theta. That's the way I see verticals, because when you buy a call option, you're buying unlimited upside. But like you said, there's only so far we think the stock can go by April, right? So why should we pay for unlimited upside? You're paying $345 to buy that $90 call option, but that's assuming that's saying that I believe Starbucks could go to 1,000 by April, and that just doesn't quite jive with me, right? So that's why we sell a higher strike. So if you pull down that drop-down menu on that sell leg, I would look at selling maybe the 97.5 or 100 strikes, because that's the one standard deviation move, right? Because there's a relatively low probability the stock is going to exceed that one standard deviation move. Even if it exceeds it by a little bit, that's still okay. But as you can see, instead of paying $345 for the $90 call option outright, I can collect a whole dollar by selling the 97.5s, which reduces the trade cost by almost a third. So what you're doing when you're reducing the cost of that trade by a third is you're reducing your total risk, you're reducing your total capital outlay to get into the trade, you're increasing your leverage because now you're controlling the same 100 shares for $100 less, and because you're short one leg, you're also offsetting some of that time decay. So vertical spreads, in my opinion, is really just taking everything, all the pros and cons that everyone has expressed, and made them better in one way, shape, or form. Made the pros better and made the cons worse, if you will. And that's how I see a vertical spread.
Tony, do you find that to do a vertical, Can a beginning trader do a vertical where the brokerages allow that?
So I tend to find that if you trade at TD Ameritrade, if you trade at Tastyworks, if you trade at Robinhood, these are firms that have been very, very easy to get approvals for trading them. If you trade at older, more established firms, I do tend to find that you need to do a little bit more work to get access to those strategies. So that's my general thought. You know, the newer firms, the ones that cater to options, tend to be much easier to trade these strategies at.
Okay. Yeah. So for if you have a level 1, you probably need to get up a level before you can do a vertical.
That is correct.
Okay, but you'd have to request that for your brokerage. But I agree. I think that's a great way to go because, like you said, you know, take the pros and cons and you minimize the cons on that. So definitely a good way to go. All right. So, you know, this was great because I wanted to show, you know, how the option play software works. And if you're a novice trader, okay, it makes it easy for you. It really does. So hats off to you guys for that. All right, let me go back. I know we're kind of, boy, we're pretty close to over time, aren't we here? All right, so let me put the PowerPoint up and let's just truck through a couple more. Tony, do you think we have time to do a hedge or are we running out of time?
Let's take a look at a hedge, right? Because, and the reason that I want to talk about a hedge, because I think it's on everyone's mind that the markets are a little overcooked, right? Things have kind of just gone up, straight up.
Yep.
Even before the trade deal was announced, it seemed like the markets have priced all that in. We have this, you know, a fairly supportive Fed interest rate policy at the moment that have just continued to move this market higher. I think there's a high amount of risk that people are concerned about a pullback, especially going into Christmas where things are less liquid. I think people still have last year kind of in mind of that meltdown we had right before Christmas. So let's talk a little bit about just taking a look at one hedging strategy going into the holidays or maybe early next year and kind of how you want to take a look at that.
Okay, so what I did here, Tony, is I just took a look at the Dow diamonds, okay? And basically, you know, we've had a nice run up since October. And this is exactly what you're talking about. I think we're facing an area where we could see a pullback before any type of continuation. So the target zone that I'm looking at here is around 274 to 267. Now, when you do a hedge, what percentage makes sense for you?
I usually tell users that you need to see at least about a 3 to 5% move to the downside to even consider putting on a hedge. Anything less than that, you're not going to really be able to in my opinion, use a put as a hedge.
Okay. So I think that's important, you know, for folks to realize is if you're going to hedge something, you got to have enough of a pullback or enough of a correction that you think is coming to make it worthwhile.
Yeah, because at the end of the day, buying puts are expensive. You need to be able to overcome the directional move with a decent magnitude move, and that needs to be at least 3 to 5% for you to overcome the cost of buying that put option.
So what do you think about this? Would this be worth doing?
Yeah, why don't we pull up DIA on options play and let's take a look.
Yeah, let me get that. Hold on one second. So in fact, I think I got the DIA slide right here. Give me 1 second. There it is. Okay. And let me magnify that in. Okay, so this was just the slide we looked at the in the PowerPoint, so we can change this over here. All right. So in this case, we're talking about puts, right?
Yeah, so what I like to do is I like to click on modify for the call option.
Right here?
Yep. Flip that to a put by clicking on the, oh, yep, exactly.
You could do that, right?
Yep. And do the same thing on the vertical spread. Click on modify and change that to a put as well. So, and then, so let's take a look at these. Well, first of all, kind of, do you have a time frame from a Elliott wave perspective?
Well, this is a 60-minute time frame. Oh, sorry, this is a daily. So we're probably talking when it does start to slide. You can see it's too early. I would not do the put now because it's still heading up. I would wait for prices to pull back, maybe go through a trend line, and then consider that. Plus, we look at a couple of other things. But for the sake of this example, let's just say we thought it was ripe and ready to go. So if that's the case, then probably you're looking at maybe a month, month and a half to come down to this level at the most.
So I would look at maybe February's or March as a
Yeah,
point.
I think that's good. February, should we do February?
Sure.
Okay.
And so I always like to use one one in the money, one slightly in the money and one slightly out of the money as a comparison.
So let's, what do you want to do? 184, try that?
No, it's at 284 right now.
Yeah, 284.
So I'm looking at maybe a let's just say the 287s.
That sounds good.
And then we'll do in the middle strategy, let's do the 283s maybe, or 282s.
Okay, so let's see what we got here. So let me just, hold on one second. I gotta go back. All right, how do I get it back to the, what did I do here? Okay, anyway, we'll do it. All right, so on this middle strategy here, that's what you want to focus on now, right?
Well, let's change that to the February.
Yeah, I had it there and we changed it over. Okay, so now what strike price you want to choose for that one?
Let's say 281.
Okay. How's that looking?
Yeah, so now let's go back to the P&L simulator, the first dot at the bottom.
Okay.
And what were your target prices on?
Target on this was let's take a look at 274.
So let's plug in 274.
Why don't we reverse it down right around here, okay? How's that?
Great. So as you can see here, what that equates to is about a 3.5% loss on the portfolio if your portfolio was the diamonds, right? On the left side. The leftmost strategy, you're looking at a 3.5% loss. So your portfolio would have lost 3.5%, or about $988 on 100 shares of diamonds. It was about a $28,000 portfolio. But you would have made $176 profit back if you had bought the out of the money puts versus a $530 profit on the in the money puts. This is why whenever we're hedging, I always advocate to use a slightly in the money put because you're going to get far better coverage. I talk about these two strategies as the out of the money is kind of like buying catastrophic insurance for your portfolio, and the in the money puts is buying comprehensive insurance. It costs more in this particular case, about $200 more.
That's a good analogy.
But as you can see, that $200 extra, in my opinion, is well worth the coverage that you get. And I think what you said prior is a very important thing, right? You said that you would not enter this hedge at this point. I think that there's a lot of people here on this webinar that would say that, hey, things are, volatility is really low. I think it's about to correct, and they would enter a put here. I always advocate buy a put on a hedge. It's better to be late than early, because when you're early, you might end up buying this put and the stock markets continue marching higher and you end up paying $400 or $500 for absolutely nothing. Yes, things will get more expensive if things start to move south already, but at that point, the more expensive protection is going to be worth it. So I thought what you said before is great.
Yeah, I agree with you on that, because I'll tell you, there's a lot of times when the markets just take a normal breath and continue on. And this is an insurance policy, so you got to pay money to do this. So there's no use in doing it too many times, because it does get expensive.
Yeah.
So I agree. All right, cool. Let me go finish up here. There was one other question I had. Are you all set with this? Tony, is there anything more you want to add to this?
I think we can move on.
Yeah, okay, that's good. All right. Okay, give me 1 second. Let me just pop up this. All right, so recently I got a question from one of our clients regarding hedging some metals that he has, and he's thinking about using the futures market. Now, one of the things that he was saying is he's got gold, he's got silver, he's got palladium, and palladium has taken off like a bandit. And if we look at the chart here, one of the things I wanted to show him real quick is that, like the other markets, this happens to be a weekly chart. You can see it's really moved nicely. If it ended today, we're looking at a correction of down into the 1461 to 1139 area. If If we look at the daily chart, shorter time frame, correction not quite as deep, okay? So this is one of these things that you're going to have to, because options play, we don't have, you know, the futures in that for options. You'd actually have to look it up on a futures chain for options. But these target zones, okay, are what you kind of want to focus on in terms of protecting your upside. But I would wait to see the actual rollover before doing it, for the same reasons that Tony and I talked about it before. So I just wanted to address that question. And I can send, this is for a guy by the name of Roman. I can send Roman you a copy of these charts so you can have them. But I would not jump on it until the market actually rolls over. All right, so I know we went over a little bit, Tony, and I thank you for jumping in as well, because I thought it was a good presentation, because I think, you know, we covered a lot of different strategies, and they're kind of simple once you understand it. And I think a lot of people get intimidated with options.
Yeah, so thank you so much, Bennett. And I hope everyone sees, you know, a different way to view the markets. You know, Bennett uses Elliott wave, which is a different form of technical analysis. I like Elliott wave from the perspective of it provides specific target prices that many times other forms of technical analysis, actually many forms of technical analysis, do not provide targets. So a lot of users will use things like momentum indicators like MACD or RSI stochastics, and they'll buy on a crossover, you know, a buy or sell, but that crossover itself does not provide any target. So you kind of have this bullish view without a clear roadmap or where you think
right.
go.
That's right.
I really think Elliott wave is an interesting tool. I will say Elliott wave is not for everyone. It is for many people. Seems like a very confusing chart. I will say, you know, especially the first time I looked at Elliott wave, and I know a lot of people that use Elliott wave, but you know, different strokes for different folks. But at the end of the day, we all converge back to utilizing options to express these directional views in the market. And that's really kind of where I think our conversations intersect, is how do we utilize options to get the best use of our capital to take these directional views in the market. So I thought that was great.
Amen.
Show that to everyone. I'm glad that we were able to cover a few different strategies and discuss why we use certain expiration dates and strike prices when we're choosing them, because that is the same regardless of how you decide your directional views. So with that, what I'll do is I'll open this up for Q&A. If anyone has any questions, please feel free to send them into the chat window. We will stay for a few more minutes to answer any questions that you might have, and hopefully help you guys with your trading. And before everyone logs off, I just want to say this is our last webinar before the holidays. So I just want to say happy holidays to everyone, and hopefully everyone has a prosperous new year. And I will see everyone on the flip side in the new year after this webinar. So with that, please, if you have any questions, type them into the chat window and we will answer any questions you might have.
Yeah, happy holidays, everybody. Have a good one, and appreciate you coming today. Tony, thanks so much, and we'll be in touch with you again.
Yeah, well, thank you so much, everyone. I hope you guys have a great afternoon or great evening and a great holiday, and I'll see you guys in the new year. Thank you so much, guys.